Hello, everyone, and welcome to this month's BMA webinar about value stream income statements and how they can be used as a tool to help drive profitable growth in lean companies. First thing I'd like to do before we get started is the traditional technical check. Can you hear me? Can you see me? And can you see the presentation? And if you can just pop your answers into the question panel. Okay, thanks. Great. All right. Hold on. All right. Let me close the question panel. And again, the usual attendee administrative functions that I'd like to remind you about, especially if you're a first-time attendee. There's a copy of the handout in the handout section of your control panel, and you can download it. If you are watching a recording of this or you forget to download the handout, just send me an email and I'll be glad to forward you a copy of the presentation. If you have any questions, put them in the question pane. I will look at the questions during the polling questions and maybe answer them or hold them till the end, depending on how many questions we have. And if you are a certified public accountant and would like continuing education credit for this 1 hour, these are the requirements. You have to attend the live webinar, answer 3 polling questions, then just send me an email and I'll send you a certificate. And if anybody just wants a certificate of attendance, not for continuing education requirements, just let me know. I'll be glad to send it to you. Okay, so let's review what we're going to talk about today. First is how it's important to understand how value stream income statements can change financial thinking and drive financial improvement over time. The value stream income statement in and of itself is not going to drive profitable growth. But if you use it as it's intended to be used in conjunction with some other tools, it has the potential to really unleash the financial leverage of lean. You should be able to explain the standard practices to develop a value stream income statement, understand the importance of presenting costs in a value stream format, and be able to explain the benefits of using value stream income statements in analysis and decision making. Okay, financial thinking. And being a longtime financial person, it was pretty easy to understand this graphic. Numbers drive thinking habits in business. If you're a manager and you're responsible for making business decisions, you're going to use numbers, okay? And the numbers drive thinking habits, and the numbers actually reinforce the thinking habits. The thinking habits drive behavior, and I'm not talking about individual behavior. I'm talking more about company behavior or process behavior. And the behavior sort of reinforces and drives the decisions. And then the decisions drive the numbers. And this is a cycle. And the more experience you have as a manager in doing analysis and decision making, you develop a comfort level with the numbers. You have experience using the numbers, and it creates these mental models. Now, the issue is that lean is about thinking differently, and it's about the way that processes perform. And so there's a big change just because of lean. And so, part of the issue is, what numbers are you looking at to analyze and make decisions? So one of the key tools is a value stream income statement. And we call it, in lean accounting, we call it a value stream income statement because value streams are the true profit centers of lean companies. If you think about this, you want to understand your value streams in order, which are basically from order receipt to delivery, whether it's a product or a service or shipment. You want to understand from a lean viewpoint value streams in order to organize and manage around value streams. And you're really trying to create flow through the value streams. And value streams are horizontal. They're not necessarily, they cut across the traditional vertical organizational structure. So from a lean accounting viewpoint, think of them as the profit centers. Now, a value stream income statement is an analytical tool for decision making. We use the words income statement, and a lot of people who are not familiar with value stream income statements automatically think, oh, it's about financial reporting, and we already have an income statement, and Nick wants us to change our income statement for financial reporting purposes, and that's not true. Think of this as an internal analytical tool for people inside the business. The value of a value stream income statement, when used in conjunction with lean performance measurements and capacity, is it makes visible the actual relationships between operating performance and financial performance. And it should say they're lean operating performance. We want the format to be in a simpler, more usable presentation for internal users. The primary users of an income statement, a value stream income statement, are non-financial people. And your external, the income statement you use for external reporting purposes, you might have certain reporting requirements, you might have to show certain details, it might be company preference, it might be industry preference or regulatory preferences. And that format can be complex and hard to understand for non-financial people. But again, your external financial statement is designed for stakeholders, shareholders, investors, things like that. What's important to understand is that all of the numbers for a value stream income statement come out of the general ledger, come out of the accounting system. It is not a second set of books. It is not a new method of accounting. So if you're trying to talk to financial people in your company about value stream income statements, just make sure they understand that. We're not promoting a new type of accounting. All right. Now, we want the value stream income statement to drive thinking habits. And I mentioned, a couple slides ago that the numbers drive thinking, and really the numbers that are used in non-lean companies can drive what's called a fixed mindset versus a growth mindset. We want a growth mindset in a lean company. So what are the characteristics of each? Well, when it comes to knowledge, the fixed mindset is there's certainty about the relationships. We are certain. These are absolute truths. A growth mindset, there is this desire to learn and improve knowledge. Like, another way to think about a growth mindset is, we don't know everything. In terms of cause-effect relationships, a fixed mindset is going to think that these relationships are linear, direct, and static. We know what these relationships are like. We've been looking at these numbers for years. The growth mindset, the cause-effect relationships are nonlinear, dynamic, and system-based. And if you think about lean and continuous improvement, these relationships can change over time. Analytical methods, fixed mindset sort of is traditional, top down through finance. Growth mindset, excuse me, is team-based and collaborative. And finally, in terms of systems, the fixed mindset, we have complex, detailed costing systems and budgeting. And in the growth mindset, the system is primarily plan, do, check, adjust, and trying to understand root causes. Lean is different, and it requires a different mindset when it comes to looking at income statements. So what are the characteristics of a growth mindset that really a value stream income statement helps drive? First is understanding the drivers of improving financial performance. All right, so financial performance is the effect. Improving it is the desired outcome. But the root causes are operating performance and capacity performance. Now, this is sort of the opposite thinking of sort of traditional financial analysis where you can sit there, do the financial analysis and say, here's what has to happen operationally to achieve these results. So make those things happen so that we can achieve these numbers. But in lean, it's a little bit different. Okay, you really have to change capacity performance. You really have to improve operating performance if you want to improve financial performance. One of the sayings I sometimes use is if you want to change the financials, you have to change the physical. Physically, something has to change operationally to achieve better financial performance. So, this is what a value stream income statement will do. It's going to help you understand the true root causes. The economics of lean, one goal of lean is to serve customers better, create more value for your customers. Okay, so if you think about continuous improvement, you create capacity. All right, if you stop doing something, or if you eliminate waste or you reduce waste in some form or fashion, you create more time, which is capacity. Now, if you use that capacity to serve your customers better, increase on-time delivery, improve quality, reduce lead times, it's possible, not guaranteed, but it's possible that it can drive a competitive advantage and more customers want to do business with you. What you get in the position of growing sales at a greater rate than costs. Now, this is something that I experienced way back when 30 years ago as a CFO when the company I was working with went on a lean transformation. And simply because, not simply, it took a while to get there, but we focused on improving on-time delivery. We dramatically reduced our lead times. And we did, and just by doing that, we also didn't rely on finished goods inventory to have high on time and short lead times. In fact, our lead time was any order that was received was shipped in 3 days. We outperformed the competition in terms of delivery and lead times. And because we were basically producing, very similar commodity type products, more people bought from us than competitors. And we were able to see our sales growth increase from like an average of maybe 7% a year up to like 20% a year. And our cost, they still increased every year, but maybe only about 5%. And that achieved this sustainable financial success. And so this is part of the thinking that you want to develop this kind of thinking habit about serving customers better. And what does that do? A value stream income statement is going to help you get there. On the other side of the value stream income statement are costs. Okay. And, another part of lean, besides serving customers better, is improving productivity. Productivity is simply increasing the output with the same resources. So what does that get you from the cost side? Well, continuous improvement events create capacity. Just about every improvement event creates capacity. Now, there might be a few exceptions if it comes to safety or it comes to employee satisfaction. But if you're looking at a process and you're improving a process, you're going to create some capacity. You may also reduce some actual costs. You have more capacity, less overtime. You improve quality. You have less scrap. You create capacity. You don't replace an employee that leaves. There's also cost avoidance. And these are actions taken to avoid having to incur costs in the future. Redeploy people, avoid hiring additional people, or maybe buying machines. Now, it's important here to measure the right way when you're measuring costs. And it's pretty much cost as a percentage of sales. I'll show you a couple examples in a little while, but lean, it's important to understand, lean isn't about cost cutting. And there are still many people out there that think that, we're going to, as the saying would go, first of all, they're not thinking right about lean, but they'll say, we're going to do lean to cut our costs. Well, first of all, you don't do lean. Lean is, you want to be a lean company. And cost reduction is an outcome of improving productivity. So those are the basics in terms of how we want to shift our thinking. A value stream income statement will do this. And we're going to do the first polling question right now. And then we'll talk more in detail about creating value stream income statements. So I'm going to launch attendance check number 1. I'm going to look to see if there's any questions. No questions, but I see lots of familiar names. I'll give you a few more seconds to answer the polling question. All right, I'm going to close it. And move on. So, excuse me, value stream income statements, as I said, they're a tool to drive thinking in terms of analysis and decision making. Value stream income statements really need to be customized for every company. There's not just one format of a value stream income statement, and you have to make it work for your company. So the recommended approach to developing a value stream income statement is to follow certain practices. If you follow the practices, you'll create and develop a good value stream income statement. So what are these practices? First, a simple format. Everyday language. Really, it's also worth the effort to simplify your chart of accounts. For example, I've worked with some companies where if you look at their labor expenses, they have, 7 or 8 different expense accounts for labor. You got labor, you got overtime, you got direct, you have indirect, you have office, you have all these different labor accounts. And, if you have a complex chart of accounts, it probably developed over time. And it developed over time in order to get that granularity on your income statement to try to, especially for accounting and finance people who, they get asked, well, why was our labor high this month? And they have to look, and they can just look through all these labor accounts and say, oh, well, this particular account was above budget, for example. Also, the language. Remember, the language needs to be simple and easy. Value stream income statements are used by non-financial people. The other practice is to report actual revenue and actual costs incurred in the reporting period. People ask me, if we use accrual accounting, do we still use accrual accounting in value stream income statements? The answer is yes. You want to categorize your costs properly between fixed and variable, direct and shared. And then you want to avoid or eliminate using allocated costs, such as standard costing, job costing, corporate overhead allocations. So let's look at these practices in a little more detail. So simple format. So here's an example of a company's value stream income statement. So they have 2 value streams, OEM and systems. And they have, you can see, very few expense line items in the presentation. That doesn't mean you can't drill down, but it's simple and easy to understand, and you can see the profitability of each value stream. This company also shows their new product development costs separately. They consider that a value stream unto itself. And then all the other expenses are categorized between sales and marketing, general and administrative, and then you get your total expenses. you can see that it's a different format too. It's not very vertical, it's more horizontal. And again, it's easy to see horizontally how things total up. So you get a good number there for value stream operating profit. And then this is a manufacturing company. So the change in inventory is what I say below the value stream profit line. And then the profit before tax is what is reported externally. So you get to see here that, the value stream profit, the value streams generated $322,000 this month operating profit. The change in inventory, which operations really can't do anything about. This is inventory valuation. That took most of that profit away for financial reporting purposes and down to 99,000. Simple, easy format. When you're looking at actual costs, and this is one of the more difficult concepts for financial people who don't understand lean and don't understand lean accounting to think through. It's in my experience, operational people get this immediately. So you're going to have direct costs. These are the costs which, reside in a value stream. I'm going to give you examples here in a couple minutes. And you can break those direct costs between variable and fixed. What's the difference? Now, again, there's many people have different definitions of variable and fixed. Here's my lean accounting definition. Variable costs vary directly with sales. There's a direct relationship. If you sell more, you have more variable cost. If you sell less, they go down. Okay. Fixed costs don't behave that way. What drives the cost is different. Okay. And a lot of it is based on management decisions. The best example of sort of traditional thinking and lean accounting thinking when it comes to variable and fixed costs is direct labor in manufacturing. Because direct labor is part of a product cost and is calculated in a variable fashion, how long does it take to make the product by a rate? The thinking over the years has developed that, direct labor is variable. But in reality, the people that work, that comprise direct labor, that cost is fixed. They get paid no matter what. No matter how much they produce, no matter what the demand is, they get paid a set rate. And as long as they are showing up for work, they're getting paid. That's a fixed cost. Now, you can increase your direct labor by hiring people. You can also decrease fixed costs. So the management decision drives the fixed costs. And in lean companies, the thinking is that more costs are fixed than variable. Then you have shared costs. And what you see here are typical categories of shared costs: facilities, operational support, and shared process steps. And you'll see here in a few minutes that you have an option in terms of how you can present your shared costs. So designing an income statement, and if you're getting started, it's best to highly recommend do one value stream first. Especially if you have maybe 4 or 5 value streams in your company, don't try to create the company-wide income statement, because what you have to do is you have to study your general ledger. Now, it's also best to have a cross-functional team, both operations and finance, to look through the general ledger and understand what is in each line item. I've been able to experience this many times with companies when sort of conducting an event for them and developing a value stream income statement. And it's really, really interesting how much both finance and accounting learn about what's in those general ledger accounts. A lot of you hear, oh, I didn't know that was in there. Oh, yeah, that's in there. Or we don't know what's in there. That has happened. So you review every line item, and what you're trying to do is every expense account, and you're trying to understand, is it a variable cost? And you identify those variable costs. And here, these are some examples here: raw materials, supplies, outside processing and services, and sales commissions that we've seen companies use. Calculate a contribution margin, which is important in a lot of decision making. Then identify your fixed costs. Okay, labor, who works in the value stream? Okay, and labor includes managers, supervisors, lean people that are dedicated to a value stream. Identify the machine and equipment costs: depreciation, repairs, maintenance, and tooling. And then you might be able to find some other costs. From there, you calculate your value stream operating margin, and then you can calculate your shared costs and get to your value stream operating profit. Now, again, this is just an example of a format. You have to decide exactly what format you want. So if you look at actual value stream costs, labor, the employees that are assigned to the value stream, where can you get that information? Out of payroll. Your payroll systems have fields, and they have probably some customized fields, and you can take people and use one of those customized fields as what value stream they're in. Now, some people sometimes ask, well, people move between value streams. You don't want to get into time tracking. That's not productive. You can use the 80-20 rule. If an employee works 80% in a value stream and 20% moves around, just put them in the one that's 80%. Materials. So this is always one of the more difficult pieces in terms of creating a value stream income statement, because it's a little bit different than cost of goods sold. So it's the actual material that is input into the value stream. Okay, cost of goods sold is what comes out. Material cost is what comes in. Where do you get that? That's going to be either purchased or issued. Now, which one do you use? Well, if you have unique materials in a value stream, you can use what's purchased. But if you have common materials that are used in more than one value stream, do what's issued. Remember the actual cost. So the actual cost is what comes in, because what happens to material? You either use it and produce a product and it gets shipped, you scrap it, or you can purchase it and stock it. Machine costs, depreciation, maintenance, repairs, and tooling. You can get all that information from the general ledger. If you understand your value streams in terms of maybe having a map, you know what machines and equipment are in the value stream. Then you might have other costs. Anything that you can specifically identify as going to a value stream, and you can get that information out of the general ledger. you don't want to get into worry, you don't want to get into really starting to allocate a lot of costs, okay? But if you get with labor, materials, and machines, you are going to cover the majority of your actual costs. And I would say, at least 80%, probably 90%. So the other is typically small. Now, when it comes to shared costs, this is a process step or it's some kind of support service that is shared by value streams. So what do I mean? Okay, a process step, that would be a production step that supplies more than one value stream, like a paint booth. Maybe you have some metal, you have some cutting and fabrication of steel at the beginning that creates components that go into multiple value streams. The support, your basic manufacturing support departments, quality, manufacturing engineering. You could even do purchasing or procurement. You could even do planning. You have to look at how you're structured to determine what the shared costs are. So the idea is, how do you want to show shared costs in each value stream to improve decision making and to better understand value stream profits? Now, I've seen companies that say, yes, we want to do it, and others that say, no, we don't want to do it. We'll just show them off to the, as more of a just one number. If you are going to assign, use a simple repeatable method. If you're looking at facilities, you want to do space. If you're looking at a support department, you want to use the average number of full-time employees that work in a value stream over the course of a month, for example. If you're looking at a production monument, percentage of output. Examples, a testing lab, production monuments, quality facilities. Now, shared costs, you will find that this takes time. Actually, the direct costs don't take as much time identifying as the shared costs, but that's why you go through the exercise with the general ledger. So once you've done that for one value stream, you sort of develop standard work, and you can use what you've learned to speed up the process of getting the value stream income statements for your other value streams. And then when you have all your value stream P&Ls, you can create your company-wide income statement. And what I meant to say earlier about shared costs, you see where sales and marketing are. Some companies decide, well, we'll have another column there. We'll call it manufacturing support, and we'll put those costs in there. So let's do polling question number 2. Okay. All right, so we have a couple questions about shared costs. So Keith asks, how would you place the cost for a resource that is shared across multiple value streams? And then you went on, Keith, I'm going to close the poll. You use the example of a marketing resource that spends time in multiple value streams. When it comes to sort of the selling, general, and administrative costs, I highly recommend just leave those out. Okay, marketing may do some work for marketing products that are in a value stream, but again, it becomes complicated to figure out how much time they're spending, and then you're getting into a cost allocation system. And so let's see, there's another question. Okay, I'll get to those later. All right, so let's go on and let me get through the presentation. All right, now I want to focus on, driving cost management, okay, and how value stream income statements can help with that. We talked about this, okay. What drives costs? It's operating performance and capacity usage, okay? Cause effect. So how do you go about managing costs in conjunction with value stream income statements? First, I mentioned this a little while ago, how do you measure it? Okay, I'm going to put up some examples of good lean performance measurements. At the company level, you can measure contribution margin. You can measure the gross margin as long as you're not using standard costs. You can also use specific costs like labor as a percentage of sales, okay? Because you want those percentages to improve over time. At the value stream level, you can use actual costs as a percentage of sales, or you can use average actual cost per unit, the actual costs that come from your value stream income statement. If you're looking at cell measurements, you want to use the drivers of costs. Okay, it's very difficult to get a cost down to the cell level. I mean, yes, you can calculate, how much you paid an employees every day, but that's not, the cost doesn't give you the cost at the cell level doesn't give you the cause, just gives you the number. So, is a relevant driver of costs or relevant drivers of costs at the cell level? So get those performance measurements in place. So reducing labor and machine costs. All right, this is, labor costs, especially in all companies, is there's like laser-like focus on this. So the actual cost of labor and machines, it's the actual costs are a function of your capacity requirements. Resources, okay? How many people do you need? How many machines do you need? Now your capacity, what's driving capacity is based on your demand and the waste in the value streams. This is why the economics of lean are so important in terms of cost management. The more waste you have in the value streams, the more capacity you need to meet demand, and that will increase your costs. An example that I use all the time is that if you have 50% waste in a value stream and you want to hire an employee, in order to get the productivity of one employee, you really have to hire two because of the waste. Okay? That's why it's important to focus on continuous improvement and eliminate that waste, and that is what drives actual costs. Improve productivity, eliminate waste, create capacity. That's the focus. And, because most of these costs are fixed, costs are measured as a percentage of sales. So how do you improve labor costs? Okay, we focus on measuring productivity. We identify continuous improvement opportunities. We eliminate waste, we create capacity. What can you do with that capacity? You can decrease your overtime. In most manufacturing companies that I have worked in over the years, there's a lot of overtime. Now, overtime, from a lean accounting point of view, is temporary capacity. Now, if your demand is up and you don't want to hire people, your temporary capacity increases to work overtime. But if you are staffed based on average demand and you have average demand and you're still working overtime, question is why? My answer, waste. So decreasing the overtime is an actual cost reduction. You cannot replace people. When someone leaves, for whatever reason, you just don't replace them. Okay, this is sort of like natural attrition. When back in my CFO days, we practiced lean inside the accounting department, and over the course of about 6 years, we reduced we reduced the accounting staff by about 40%. We didn't fire anybody, but a couple people left for other jobs and we didn't replace them. A couple people did internal moves, like one person went from accounting, wanted to work in customer service because there was a customer service opening, and we encouraged that. And we didn't have to replace that person. And so our accounting labor cost as a percentage of sales went down. You can also do strategic redeployment of people. Okay, you can move people around between value streams. If you have available capacity in value stream A, but you need capacity in value stream B, can you move people? All in all of these activities, actions will reduce labor costs as a percentage of sales. In terms of machine costs, you know, the focus of continuous improvement on machines is reducing downtime, reducing changeover time. You want that machine available. Can you change cycle times? Well, possibly. That's typically difficult to do because of the engineering of a product. But anyway, just focus on the waste, downtime, and changeover time. You create capacity. You can use that capacity to avoid or delay buying new machines. My example from my CFO days, we had an injection molding department, and we may have had like 10 machines, 10 injection molding machines. In the days before we were a lean company, we never had enough capacity, and the machines were down, long changeover times, things like that. We started practicing lean in the injection molding department, and we ended up having excess capacity because our changeover times went down and our productivity improved dramatically. So we were able to grow the business without buying any expensive new machines. Reducing downtime can also reduce repair and maintenance costs. I've seen some companies that because they don't have enough machine capacity, they outsource. Well, if you increase the capacity of your machines, you can reduce your outsourcing costs. All in all, your machine cost as a percentage of sales goes down. Now, material costs. Remember, material is a variable cost. Okay, so it's going to operate a little bit differently than fixed costs. But if you think about the basic equation to understand what the total material cost is, it's price times quantity. Okay, so how do you manage this equation? That's the key. On the price side, from a lean thinking and lean accounting viewpoint, you want to focus on the lowest price with the highest quality, highest on-time delivery, shortest lead times. You don't chase the lowest cost supplier because you might not get the quality, you might have long lead times, and a lot of times the supplier will say, well, sure, I'll give you a lower price, but buy 3 months worth of materials and I'll give you that price. Okay, you don't want to do that. The usage side is where you gain reduction in material costs. If you reduce the lead times in a value stream, you're going to flow that material faster. So it's not going to be on the books as long. If you have inventory, if you reduce the days of inventory, you're going to reduce the actual material quantity. Because remember, it's how much comes into a value stream. If you improve quality, you're going to reduce your scrap. So you want to measure the contribution margin, the sales less the actual material cost on the value stream income statement, and see the contribution margin improvement over time. This is why it's really important for it to be the input. Now, if you're looking at decision making using a box score, so for example, here we have 7% available capacity. You can see the current state value stream P&L. We have an opportunity to sell 1,125 more units. If we calculate a future state box score, we see we don't have enough capacity. You can see the profitability of the contribution margin of that additional business is good. So what do we do to get that capacity? Well, you can hire more people and you can see the change in costs, everything in yellow there. Now you can also see the change in performance. So the future state contribution margin goes up. Now it doesn't go up $20,925 because we have more material cost or we have more scrap. And the labor cost goes up, a little over $9,000. So do we make more money, $21,100 than the current state? Yes. But, can we do better? What happens if we made improvements? Okay, if we improve, if we reduce our scrap, if we reduce our downtime, that gets us the capacity we need, and it actually gives us even more value stream profit. Why? Because we're reducing scrap. Even though we're buying more, we're reducing scrap, and our labor cost is fixed. So now these decisions are based, like when you're looking at a demand decision like that, it's based on time frame. Okay, if this demand is coming in the future and you have enough time to do the improvements, great. If not, you might have to hire people. But this is one point I wanted to make on this is that you really want your rate of continuous improvement to be greater than your rate, or at least equal to your rate of sales growth. Okay, polling question number 3. Alrighty, give you about 10 more seconds, then we'll wrap things up. have a lot of questions here. Hopefully I'll be able to get to them. Wrap up is pretty fast. All right. Okay. Remember, you'll get a survey when I close the webinar. Please complete it. And remember, if you want continuing education credits, email me. So, the value stream income statement are the numbers that help drive lean financial thinking. We're trying to get people to understand the relationships, the lean relationships between operating performance and financial performance. We want the behavior to be PDCA, understand the root causes, avoid the fixed mindset. And, in terms of decisions, we just want to improve economic value. And if we improve operating performance, good. If we improve capacity performance, good. Because improving operating performance, improving capacity performance will eventually lead to improving financial performance. And then there are some things which dramatically improve financial performance. So these are the steps to create the process to create a value stream income statement. Create the team, design the format, pilot one value stream, use Excel to map your expenses to your format, practice with that one value stream analysis and decision making, and then do a check and adjust. You'll find you might have to change some things around. Then you can develop standard work, and then you can use that standard work to go into other value streams and create it a whole lot faster. And then finally, you want to get around to automating this, okay? And I've seen companies do this. They're able to use business intelligence software, reporting software where they can pick the objects out of the general ledger and create the value stream income statement automatically, okay? But, make sure you have your standard work down before you automate. If you have any questions about the process, let me know. Okay, before I get to questions, just a couple wrap-ups. The certification program, Lean Management Accounting and Lean Accounting Process Improvement. For everyone who attends this webinar, you get $100 off between now and March 31st. You don't have to complete it by March 31st, but you gotta register. So if you're interested in registering and taking the class, there's a registration form on the website, or you can just email me and we'll get you set up. And I set the second quarter webinars up. It's the value stream management series. So these are 3 webinars that all are about value stream management. Value stream management is the integration of lean accounting with lean practices. So that's going to be April, May, and June. I encourage you to sign up for all 3 because they're all connected. Okay, so let's see. Let's see. Looking at questions. So Agatha asked if I ever created or realized value stream income statements for a services company. The answer is yes, and they're actually a little bit easier to do than manufacturing. All right, what is a monument cost? From Dan. Monument is a shared production resource, such as a paint booth. Okay, and so you can calculate the actual cost of the paint booth, and then you can assign those to value streams. Galena asked if maintenance and quality department costs are direct or shared from a value stream perspective. Maintenance typically shared because you don't dedicate, you know, you don't usually dedicate maintenance people to one value stream. They work wherever the maintenance requirements are. Quality can be a little bit different. You might have quality people that work in certain value streams. They can be direct. You might have quality people that are more general in nature. That would be shared. And then Steve asked, I know we're gone over a little bit. Hold on, it's a big question. So Steve basically said the change in inventory captures only capitalized labor and overhead. It could also be the change in the material cost too. I mean, that's the reconciling item. And Askar, I don't have time to get to your question. I'll look at it. Why don't you send me an email with this question, and then I will follow up with you. And I think that really takes care of everything. Thanks for attending. I hope to see you next month, where we're going to talk about planning a lean accounting or lean management accounting transformation. So all of you have a good day and see you soon.